Hello and welcome back to another episode of Stock Pods. For this video, we are covering my favorite stock of all time, Tesla. Stay till the end as I'll be discussing reasons for buying before the split, potential benefits of a split as we'll see both with Apple and Amazon case examples, as well as what's Tesla's post-split timeline looking like for the next few years. I really want to make a second video on why this company is the biggest position in my portfolio and why I'm so confident in it. So if you want to see that, please drop a like real quick and let's go for at least 50 likes on the video so I can gauge if there's enough interest for uploading that. And if you haven't already, hit that subscribe button and bell notification to stay up to date with my watch list and analysis videos. Now, Tesla's first ever stock split is a historic moment for investors, especially those that have been with the company long before the big hype in the past few years. Tesla is the biggest position in my portfolio, and I've been stockpiling shares since 2018 for this kind of moment. Before the split, total outstanding shares for Tesla are at 186.36 million in the market. This is why the shares are so volatile, and short sellers have been taking advantage of this low float for many years. It's why Tesla has explosive moves up and down on a week-to-week basis, because the shares are very limited for such a well-known growth company, and this can explain the high premium they're trading for right now. After the split, there should be about 931.8 million shares outstanding, just shy under 1 billion. Now, this doesn't mean Tesla will be as volatile, but we will notice a difference in trading patterns since many more investors will get to buy into the company. Of course, it was impossible to predict when exactly the split would happen. Many investors and Tesla enthusiasts had a general guess it could be coming soon. But I want to draw your attention to this very controversial tweet from May. The very tweet saying, "Tesla stock price is too high in my opinion," that led traders to panic sell and caused Tesla stock price to drop 12% in a single day. Now in the moment, no one had any sense of what Elon Musk was talking about. Elon being the usual cryptic tweeter, my mind was blown when the dots finally connected. He tweeted this on May 1st at 8:11 a.m. Eastern Time, the time zone which is the standard consideration for the Nasdaq exchange and Wall Street being on the East Coast. Now, this could be a conspiracy theory stretch, but stay with me here because I believe the coincidence is way too insane to ignore. The time of the tweet being 8:11, 8 referring to the 8th month of the year, being August, and 11 referring to the 11th day of that month, coming out to 8:11 in numerical terms, which ended up being the day the split was announced. Furthermore, the day of the original tweet was May 1st. May represents the number 5 since it's the 5th month of the year, and the first day comes out to a value of 1. So in numerical terms, 5-1, which was the announced split for Tesla shares. Literally, this tweet refers to the stock price being too high. So Elon's answer was a stock split, which could have already been in the plan since May, and this was his way to hint at it secretly. Look, this man is a genius, and I'm not even surprised at this point that he actually pulled this off right under our noses. Coincidentally or not, checkmate SEC. Alright, so jokes aside, why exactly is Tesla splitting their shares? From the company's standpoint, they want to make shares more affordable for new and younger investors to buy into the company. From a market standpoint, this isn't as needed in a world where fractional shares are available and you can buy smaller parts of a stock. But I totally understand the dissatisfaction with not owning a whole share, because you feel like you won't make as big of a return, so you'll focus on cheaper stocks you can own as a whole. With a lot of EV and fuel cell companies IPOing this year, there seemed like they could be a more affordable bet for those that feel like they missed out on the big run with Tesla. But I'm telling you this now, it's more about quality than quantity of shares when it comes to investing. And Tesla is the king of EV exposure than a stock like Nikola with nothing on the market right now, no offense. But that's something I'll be saving as a discussion for another video. I believe many new investors will benefit if they buy before the split, especially if planning on holding the stock for long term anyways. It's a win-win situation. If the stock price rises after the split, then you're in the game early. But let's say if the stock price does drop, and for reasons like old investors profit taking, for example, then you have the chance to average down your cost and you can buy more shares to build a solid position. Like I said, Tesla's main priority for this split is to make shares more affordable, not just for their employees, but for new and young investors alike. Fans and customers respect the time it takes behind the quality of Tesla products, something many Wall Street analysts just don't get. It's in Tesla's benefit to favor retail investors better, as everyday people like you and I will not get in the way of their value creation process. This is something most institutional owners don't care about when all they want is profitability as soon as possible, limiting explosive growth potential for the future. For this reason, nearly 30% of the company is owned by retail shareholders. This leads me to my next point about short selling being much more difficult after the split. Tesla is one of the most shorted stocks in the market, and this caused their stock price to drastically fluctuate for many years. An increase in shares for retail investors to buy can make short selling much more difficult, especially if lower institutional ownership can restrict the supply of shares available for shorting. S&P 500 inclusion is a decision many are wondering about since the latest Q2 earnings report. The inclusion rule states that a company must have 4 consecutive quarterly profits in a row to be considered, alongside other factors like a high enough market cap value. While Tesla achieved this, speculation around why they haven't been included yet could be due to the S&P committee waiting on Tesla to show more consistent profit due to a long history of negative earnings. My guess is if the committee will make a potential announcement, it'll be in September when they do their quarterly rebalancing. And Tesla's stock split could help with making more shares accessible for inclusion in S&P 500 index funds. Finally, liquidity and accessibility will probably be the most important reasons for splitting the stock. Considering the 2020 election is coming and with the market being at all-time highs, it's smart to take any measure possible to reduce the risk in the chance of a big market crash happening this fall. Especially at a high price, Tesla would have been one of the first stocks sold by many institutional owners that got in at cheap prices, or desperate shareholders that are looking for liquidity. A split gives a good appearance for a lower priced and more accessible stock in an age where anyone can invest simply from their phones. A company only splits their stock if they have confidence for future growth, while increasing shareholder value too. To give you a perspective of why this first split for Tesla is so important, I want to talk about split history examples for Apple and Amazon in the past. As you might know, Apple is also following a similar move like Tesla, and they're planning to split their shares once again at the end of this month. It's been 6 years since the last split, and shareholders have seen their wealth grow tremendously. Apple first IPO'd in 1980 at $22, which is the original price with no split adjustment. It wasn't until 1987 that they announced their first stock split. Let's go through an example and say you were looking to become a long-term investor of Apple before the first split. This was when shares were trading around $80, so you buy your first starter position of 50 shares, which comes out to an initial investment of $4,000. Remember, the following calculations I'm making are not reflected in stock history charts because of automatic split adjustments that have been done. So I'm going to be calculating with a little bit of math to reflect the actual share prices each time the split happened in the example I'm showing. When the 1987 2-for-1 split happened, your shares doubled to 100. Fast forward to 2000, around the dot-com bubble crash, Apple announced another 2-for-1 split. Your shares double again, this time to 200, and now they're valued at $10,000, based on the stock price at the time. Again, in 2005, Apple did another 2-for-1 split, doubling shares once again to 400, equity now valued at $16,000. After this, Apple held off a split for many years, until 2014, when share price grew all the way to $700, and Apple announced their biggest split yet, 7-for-1. Meaning you now have 2,800 shares, valued at $280,000. The pattern was very similar for all these splits. Apple always split as needed to make sure share prices were repriced post-split around $100 each time, attractive enough for new investors to join. Now we're finally in 2020, and Apple has hit their biggest achievement yet of being the most valuable company at over $1 trillion valuation. Shares should be multiplied again, this time to 11,200, and your position would be valued between $1.2 to $1.3 million, based on whichever closing price we'll get eventually at the end of this month. Now, this is straight equity growth too, and this isn't even factoring dividends from all those years since Apple first started paying it out to shareholders. Apple has a little over 4 billion outstanding shares, but investors still seem to get insane growth no matter which split era they enter at. Let's take a look at another example with Amazon this time. They IPO'd in 1997 at $18. Again, the price is with no split adjustment that's shown on the charts. The stock was trading around the low 60s before the first split in 1998. Let's say you decided to become a shareholder right before the split deadline and bought 50 shares. After the split, your shares would have doubled to 100, and they'd be valued at the same $3,000 you put in your initial investment. The following year, in 1999, Amazon shares hit insane growth, and they followed up with another split, this time 3-for-1. So your shares tripled to 300 for a total value of $23,952. Remember, this is also around the time of the dot-com bubble, so many companies were trading at insane valuations for their time. The same year, Amazon did another split for some reason, this time 2-for-1, meaning your shares would have doubled to 600. However, this is an example of stock valuation dropping this time after a split compared to Apple, which grew after every split. Your position would have decreased to $22,995. After that, Amazon stock went through many ups and downs, but it hasn't been till the recent years that Amazon has solidified its dominance as a contender for the world's most valuable company. If you held your 600 shares till now, it would have been worth around $1.8 million. The estimate I'm making based on Amazon's recent closing price of $3,147 per share last week. Amazon has not mentioned anything about a stock split yet, even though their float is sitting a little over 500 million shares, which is going to be less than Tesla's once the 5-for-1 split happens. However, Jeff Bezos has mentioned they don't really need retail investor interest, and they prefer to continue rewarding their investors that have long supported the company. They are at a good point of their company life cycle, and they're just getting started with churning out more profit as they continue dominating e-commerce, cloud, shipping, logistics, and more. Now you know why a stock split is so valuable as an early investor in a company. Your shares will continue to compound with each potential split, alongside equity growth too. All you really have to do is just hold and be patient if you truly believe in the company. Tesla is barely at its first split in history, and we don't know how many more will come along the way. But like I said before, a company only does stock splits with confidence, and Tesla is on track to being very successful. If you're wondering what's in store after the split, well, you have a lot to look forward to, as there's a lot happening with the company. Looking at Tesla's post-split timeline, Battery Day is up as one of the most long-awaited days for investors. This event should be covering the latest improvements in battery efficiency and powertrain technology, involving improved mileage ranges for each vehicle, as well as the rumored million-mile battery that'll be talked about. Tesla's Q3 earnings are in October, and this will be an important one to watch in order to see if Tesla continues their record of profitable quarters. This will reflect much of summer's deliveries, and it'll provide a better outlook on whether sales are growing, especially after Q2 being one of the most severely impacted quarters because of COVID. Tesla is continuously expanding with their Shanghai Gigafactory and making major improvements based on demand. The Model 3 was the #1 selling electric vehicle in China last month, and Tesla isn't just stopping there. There are reports of a new compact vehicle being exclusively designed there for the Asian market, and Tesla has been aggressively hiring for this reason. They've also launched their own insurance brokerage there. and they're getting really serious about becoming a household brand name for Chinese customers. Full self-driving is expected to launch at the end of this year, an ambitious but possible achievement based on how well Tesla can deploy this. According to Elon Musk's tweet from a few days ago, the Tesla team is working on a complete autopilot and full self-driving rewrite, which is going to be a serious jump in improvement rather than just a small tweak. And this is coming out as a limited public release within 6 to 10 weeks to early access owners that have already been beta testing these features. Berlin's Gigafactory and the Terafactory in Austin, Texas are currently in development. The Berlin Gigafactory will target the European market, and it's being built at record speed to be finished before July 2021. This is a much faster build rate than what it took for Shanghai Gigafactory, and it's all because Berlin's factory is using a prefabricated process to put together portions of the building in separate locations, which is then transported and installed as a whole at the main site. This factory will focus on Model Y production, and it will be the only one in the world with a next generation paint shop for color options we've never seen on Tesla vehicles before. Texas Terafactory will be the biggest factory, and it will stand at about 2,000 acres, being the only one with sightseeing features like a nature boardwalk, and even hiking and biking trails alongside the factory, all of which will be open to the general public for visiting. This one will manufacture Model 3 and Model Y vehicles, but it will specialize as the sole factory for Cybertruck and semi-truck production, which will launch in 2022 most likely. There is so much to be excited for right now, and Tesla is going to be in the spotlight for a while. While many automakers are shutting down and even closing manufacturing sites permanently, Tesla is doing the opposite, and they're building gigafactories at unbelievable speeds and efficiency. This is why there's so much demand for the shares, and I'm confident this stock split will reward old and new shareholders alike. Believe in the company, and that same company will reward you for your patience and trust. I hope you enjoyed the video, and leave a comment below on any feedback and whether you're confident in Tesla as a company. Thank you for watching, and I'll see you next time.